Hello students, I am Archana Bhatt, lecturer in the Department of Commerce. In this session, let us start with our first chapter, that is Introduction. So these are the contents of this session: Introduction, Income Tax, Assessment Year and Previous Year. So in this session, we are going to study all these aspects. So before knowing what is income tax or what is direct tax, we should know what is tax. The money that you have to pay to the government so that it can provide public services is known as tax. Tax is the most important revenue of the government. It is a mandatory fee or financial charge levied by the government on an individual or an organization to collect revenue. Okay. Then the collected fund is used to fund different public expenditure programs like providing infrastructure facilities, defense, police, judiciary, public health, schools, building of schools, colleges, factories, etc. Tax can be classified into two types. One is direct tax and another one is indirect tax. Direct tax is the tax which you pay directly to the government, like income tax, corporate tax, wealth tax, etc. So here the money which is directly paid to the government is known as direct tax, and indirect tax is the tax which you pay indirectly to the government, like goods and service tax. Now in India we are following GST as our indirect tax method. So here tax is levied on goods and services. Here the consumer who purchase the goods or who obtain the services pay the tax indirectly to the government. So the next concept is income tax. Income tax is one of the forms of direct tax. The Income Tax Act of 1961 regulates the collection of income tax from the public by the central government. Here, income tax is the tax imposed on one's income, and every person whose taxable income for the previous financial year exceeds the minimum tax liability limit is liable to pay the income tax during the current financial year on the income of the previous financial year at the rate in force during the current financial year. So here everyone whose income exceeds the minimum limit, okay. So at present in India, the person or an SSC whose income is more than 2,50,000 has to pay the tax. Here the person whose income is below 2,50,000 no need to pay the tax. So there is one tax slab, according to that they have to pay the tax. So let us discuss that tax slab in the next session. This income tax is the most important and significant source of revenue to the government. So we pay income tax to the central government. Then this tax is apportioned between the central government and the state government as per the recommendation of Finance Commission, which is appointed every 5 years. In India, the Central Board of Direct Tax, that is the CBDT, is responsible for the collection of income tax. So here remember this point, CBDT, that is Central Board of Direct Tax, is responsible for the collection of income tax. That means they collect income tax in India. Income tax is one of the most important types of direct tax, and it is the tax levied on the income of the public or income of the individual. The income tax is one of the most important types of direct tax, and it is the tax imposed on one's income. Here, this income tax is paid by the person whose income exceeds the minimum taxable limit. Okay. Next concept is assessment year. So, the assessment year means the period of 12 months commencing on the first day of April every year and ending on 31st March of the next year. An assessee is liable to pay tax on the income of the previous financial year during the next assessment year. So, assessment year is the period of 12 months commencing from the first day of April and ending on 31st March of the next year, and here an assessee is liable to pay the tax not for that assessment year but for the previous year's income in this current assessment year. So, the current assessment year is 2020-21. In this year, they have to pay tax on the income earned in previous year, that is income earned in the year of 2019-20. Then what is previous year? The financial year immediately preceding the assessment year is known as previous year. Preceding means just before. So, here the financial year before the assessment year is known as previous year. As I told you, financial year begins on 1st April and ends on 31st March. But in case of newly set up business or profession during the financial year, the previous year will begin from the date of setting up of the new business or profession. For any newly set up business or profession, the financial year begins from the date of setting up of that business or profession, and it will end on 31st March only. Okay. In this case, the first previous year may be of less than 12 months. For example, if a business commences on 1st October 2019, the previous year will be of 6 months, because here financial year starts from April 1st, but here they started business on 1st of October. So, their financial year will be from 1st October 2019 to 31st March 2020. That is the period of 6 months will be the first financial year for them. But from next year onwards, the previous year or financial year will be of 12 months. So, in simple words, we can say that the year in which the income is earned is known as previous year, and the next year in which this income is taxable is known as assessment year. So, in the assessment year, that is in this assessment year 2020-21, an assessee will pay tax to the income he earned in 2019 and 20, and he is not paying the tax on the income earned in the year 2020-21. There is no compulsion on any assessee to close his accounts on 31st March only. Okay, here if for any reason that may be personal reason or that may be religious or any other reasons, if the assessee wants to continue his business to close his account on a different date, he can do so, but he would be required to make up his accounts on 31st March also. because here income tax returns will be filed on the income earned till 31st March in every year. So, for that purpose, for filing income tax return, they have to close their accounts on 31st March also. Assessment is the year in which tax is payable. Previous year is the year in which the income is earned. Okay, here on the income earned in previous year, an assessee must pay the tax in the assessment year. There are some exceptions to the general rule. Here, what is that general rule? The general rule is that income tax is charged on the income of the previous year during the assessment year. Here, exception means against the rule. So, in some cases, the income tax is charged on the income of the previous year in the same year. That means they have to pay income tax in the same year in which they earned income. So, the exceptions are as follows. First one, income of non-resident from shipping business. Second one, income of persons leaving India. Third exception is bodies formed for a shorter duration. And fourth one, transfer of property to avoid tax. And last one, the discontinued business or profession. Let us discuss these points one by one. First exception to the rule is income of non-resident from shipping business. So here, who is a non-resident? Non-resident is a person who is visiting a particular place but who does not live in that place permanently. So here non-resident is a person outside India coming to India to do some business. So here to become a non-resident there are some rules that we have to study in the coming chapter. So here you remember just this much. Non-resident is a person who is visiting a particular place and not living there permanently. So if a non-resident carrying business in India, that will be taxable in India because he is earning income in India. So he should pay tax in India. The shipping business of a non-resident which has no representatives in India, any income derived from such business should be taxable in the same year. Okay, here non-resident carrying business in India must pay the tax in the same year of business because once the business is over he will leave India. So there is no guarantee of payment of tax. Because of that reason in the same year he should pay the tax. Here the business may be carrying of passengers, carrying of livestock, goods or mails, etc. So here in ship he may carry passengers or goods or mail, anything. So before leaving the port of any port of the country, he should pay the tax or he should make arrangement for the payment of tax. When non-resident after his business leaving India and there is no representatives in India, he should pay the tax in the same year. In this case, there is no question of payment of tax in the assessment year. Okay, here he should pay the tax in the same year. 7.5% of the amount paid or payable on the carriage must be paid as tax on such income. Okay, ಇಲ್ಲಿ 7.5 ಟ್ಯಾಕ್ಸ್ ಅವರು ಪೇ ಮಾಡಬೇಕು ಯಾವುದರ ಮೇಲೆ ಆನ್ ದ ಅಮೌಂಟ್ ಆಫ್ ಗೂಡ್ಸ್. ಸೊ ಟಿಲ್ ದ ಟ್ಯಾಕ್ಸ್ ಹ್ಯಾಸ್ ಬಿನ್ ಪೇಡ್ ಆರ್ the arrangement made, the ship will not be allowed to leave the port. ಮನಿ ಪೇ ಮಾಡಲಿಕ್ಕೆ ಅರೇಂಜ್ಮೆಂಟ್ ಮಾಡುವ ತನಕ ಅವರ ಶಿಪ್ಪನ್ನು ತಗೊಂಡು ಹೋಗುವ ಹಾಗೆ ಇಲ್ಲ. ಸೊ ದ ಸೆಕೆಂಡ್ ಎಕ್ಸೆಪ್ಷನ್ ಈಸ್ ಇನ್ಕಮ್ ಆಫ್ ಪರ್ಸನ್ಸ್ ಲೀವಿಂಗ್ ಇಂಡಿಯಾ. An individual may leave the country for a long period of time. Okay, at that time he must pay tax till the date of his departure. For example, if an individual decides to leave the country on 15th September, he should pay the tax till that date, that is till 15th September of this year. Then the department issues an income tax clearance certificate after payment of the tax, that is from 1st April to 15th September. The department issues the income tax clearance certificate. Only after getting that clearance certificate he can leave the country forever or for a long period of time. That means if any person wants to leave the country and whose income is above the minimum limit, he must pay the tax till the date of his departure. Next, third point is bodies formed for a shorter duration. Here any body of individuals or any association of persons formed for a particular event, then they have to pay the tax in the same year, because they will dissolve that body after completion of that particular event. The assessing officer feels that such association or body is likely to be dissolved in the same year, they have to pay the tax. Okay, here that is the third point, bodies formed for a shorter duration for a particular event. Next concept is transfer of property to avoid tax. Sometimes an SSC may transfer his property to someone else to avoid payment of tax. Okay, if in the opinion of assessing officer, an SSC is likely to transfer his property to avoid tax, his income must be taxed in the same year of transfer. Here, if the assessing officer come to know about this fact, that is an SSC is transferring his property to someone else for the purpose of avoiding tax, here his income should be taxed in the same year. Here assessing officer will not wait till the next assessing year. The next concept is on discontinued business or profession. The income for the period from the expiry of the previous year until the date of discontinuance in the assessing year is charged to be taxed. Here, if any business is discontinuing in this assessment year, here they have to tax, they have to pay tax till the date. They cannot pay tax in the next assessment year, because in the next assessment year there will no business, there will no entity. So when they decides to quit their business or discontinue their business, they have to pay tax. For example, any business want to discontinue or dissolve their business on 30th of this September, they have to pay tax till that date in the same assessment year, that is in the year of 2020-21. So these are the exceptions to the general rule, that is income tax is paid during the next assessment year on the income of previous financial year. That means in these cases they have to pay income tax on the income earned in the same year. So this is about the introduction, that is what is tax, what is direct tax, what is indirect tax, what is income tax, and when the Income Tax Act was introduced in India and who collects income tax in India? That is, the Central Board of Direct Tax is collecting income tax in India, and Income Tax Act was introduced in the year of 1961. And about assessment year, about previous year, and exceptions to the general rule, that is taxation of previous year's income during the same assessment year. Let us stop this session here only, and in next session let us discuss other topics. Thank you students. Let us meet in the next session.